So using different types of investment accounts can help you achieve tax diversification. It can give you more spendable income in retirement, right? Isn't that what we want? And there's really three types of accounts that we think of: tax deferred, tax favored, and taxable. And while we know there will always be taxes, again, we may not know and be able to foresee those changes in tax rates. So that's why tax diversification is so important. Because when we use a wide range of investment options in retirement planning, you might be able to pay less in taxes. As you start to take money from these different accounts, and if they're taxed differently, this can lead to you having more disposable retirement income for you and your family. So let's start. We're going to go through first, and we're going to talk about this first category, which is tax deferred accounts. These are the most common approach we see to retirement planning. It doesn't mean it gives you the best outcome. It just means that we see this to be the most common approach. So the first thing we think of is tax deferred accounts with pre-tax contributions. And I know that's a mouthful, so I'm going to give you some examples. This would be like a traditional IRA, a 401k, a 403b, deferred comp, defined benefit plans. These are accounts that we put money into today that we don't pay taxes on. So I contribute to my 401k, I put in 3%, my company puts in 3%. And, if I'm doing that all in a pre-tax, not a Roth, then that money goes in today that I haven't paid taxes on. So I get a tax deduction for that. I'm not taxed on that income. It's going to grow tax deferred. So I don't pay taxes while it's growing. But when I go to take money out in the future, when I go to take money out in retirement, I am taxed on every dollar, every single dollar that comes out. And I am taxed at my highest marginal bracket. So I mentioned the client yesterday who's got Social Security and a pension. She actually has two pensions. Her husband passed away. She's got her pension, her husband's pension, and then her Social Security. So she already has like a good baseline for retirement income. And then when she goes to take out these required minimum distributions, that gets added on top of her income. And then she has to pay taxes on that at her highest marginal rate. You also have to follow IRS guidelines, and there's a lot of them. There's a lot of IRS red tape. Let me just tell you a few. Okay, so you put money in these accounts. You can't touch them until you're 59 and a half. Some plans allow you to touch them at 55, but a lot of plans you can't touch them until you're 59 and a half, or you have penalties. Not only do you have taxes, but you have penalties. And then you can only put a certain amount of money per year into these accounts. They may have income limits. If you make over a certain amount, you can't put any money in at all, right? And then you're also going to have what's called required minimum distribution. So that means at some point in the future, you're going to have to start pulling money out, whether you need it or want it, and you have to follow the IRS's guidelines, or they penalize you for it. And you go outside of any of those rules, and there's penalties. If you take it out early, if you don't take it out when you're supposed to, if you put in too much, if you make too much, right? These are all things that you can then have penalties. So again, nothing wrong with these accounts. We just have to understand how they work. And we have to understand how they're going to work when we get into retirement and we start taking money out of them. They're the most common approach that we see to retirement, but it doesn't mean it's the best. And it's the most common because it's systematic and automatic. Most of these are employer-sponsored plans. So it's your 401k, 403b, 457, right? These are plans that we checked a box on, and they started taking money out of our paycheck and putting it into the account, and they just started doing it systematically and automatically, and we didn't even look at it, right? It didn't even hit our bank account, so we didn't have to make a decision. It just did it for us. And this is why they're so successful. Not because they're the best, because it made it easy, because it made it systematic, because it made it automatic. The other type of account that we talk about are tax favored. So those are tax deferred. We have tax favored accounts. So let's walk through how these work. These are funded with after-tax dollars. That's why they're not called really tax-free, because you have to pay the tax sometime, and we pay the tax today. So remember how I said we are historically in low tax brackets today. Low tax brackets today. So this is why tax favored accounts can be a good option, because let me go ahead and pay taxes today at a lower rate So that then as it grows tax-free. So I have to pay tax today, and then as long as everything is structured properly, I don't pay taxes again. It grows tax-free. I can take money out of them tax-free. Right? So this is why we call them tax-favored. Examples of these accounts: municipal bonds. Now we're in Florida. I'm in Florida. Florida doesn't have a state income tax, so I'll tell you we don't use a lot of muni bonds, but that is an option for you. Roth IRAs, 529 plans are mostly for college savings. One thing I have on here is HSAs. Those are health savings accounts. It's more for medical expenses, and you're only eligible for those if you have a high deductible plan. So I didn't include that here. And then you've also got cash value life insurance. And all of these are tax-free when it's structured properly. So we're going to get into more detail on those, how they work, how you put money in, how you take money out. And so we're going to talk a little bit more about those in a little bit. But those are tax favored. Then you have taxable accounts. I call these taxed as you go. Examples would be money market funds, CDs, mutual funds, stocks, bonds, real estate rentals, right? These are things that we don't put in like a pre-tax vehicle. You could think of these as like brokerage accounts or a non-retirement investment account, but we call these taxed as you go. They're funded with after-tax dollars, just like the tax-favored are. But what's going to happen with these is you generally will get a 1099 every year, and where you have to pay taxes on any sort of income that comes in. So that interest you earn on those CDs, right? It's taxable. So CDs have been very popular in the last few years because interest rates are so high. They're just not super popular come tax time because you realize, okay, great, I got 4 or 5%, but now I have to pay taxes on all of that. If you've got stocks, bonds, mutual funds, ETFs, you may find that you've got a tax impact on those too, because even if you're not taking money out of them, because as interest comes into the account, dividends come into the account, any sort of like realized capital gains, these are things that we have to pay taxes on along the way. But you do have a lot of flexibility, some flexibility and choice here. One thing I like about taxable accounts is you don't have as much IRS red tape. There's no income limits. There's no contribution limits. There's no required minimum distributions. There's no early withdrawal penalties. So you actually have a lot more flexibility and control with these accounts. And the other benefit is when you go to take money out in retirement, it's not all going to be taxable because you've been paying a little bit of taxes along the way. So when you go to take money out, you're going to have part that's going to be taxable and part that's going to be tax-free. So it can help you when looking at your tax planning and saying income planning. So here's the income that I'm going to have coming in retirement, these different accounts it's coming from. If we think about those 3 accounts we just talked about, maybe I've got some coming from tax deferred, so I know all of that's taxable. Maybe I have some coming from tax favored because there's no taxes. And then maybe there's some from the taxable account because that's partially taxable. And this is an area in which we help clients. First, figuring out where are you today and looking at how much do you have in these 3 areas, right? Taxable, tax favored, tax deferred. How much do you currently have in these 3 different buckets? And then we can also kind of play what if and like fast forward you to retirement and say, what is it going to look like when you get in retirement? And this is going to help you think through, what should I be doing today? If I'm saving into these different accounts, or maybe, I'm only saving into one and not the others, like, do I need to continue the path that I'm down, or do I need to make some changes? And so that's something we help clients with. We actually kind of put this information together in like a super easy like pie chart for you to see, so you can see how much is in tax deferred, tax favored, and then partially taxable, so you can make decisions around that.